Hello guys, this is Ronnie Velasquez and I'm sending this video because I wanted to share with you a brand new program we just started this past week. This is a new program that if you haven't heard about it, you heard about it here first. So let's get started. This is called the 3.5% FHA Own Option Loan Program, the 3.5% FHA Own Option Loan Program. Now, before we get started with the program, I want to talk to you a little bit about me if you don't know me yet. My name is Jackskin Ronnie Velasquez. You can call me Ronnie. I am a mortgage loan officer of 18 years licensed under Bank One Mortgage, which is a direct lender. I have personally closed over 2,000 transactions and I have worked on every loan program available. I am fully bilingual, así que puedo encargarme de tus clientes también. I am the creator of a first-time homebuyer training system that teaches consumers the process of the loan from A to Z. If you want to know more information regarding that, just call me, text me, or send me an email. I'm also the trainer of record for ReesSeminars.com. I have been a real estate and mortgage trainer for the last 13 years. I have trained over 6,000 agents, and I have over 300 training videos in my training website, www.reesseminars.com. Check them out. I'm also the creator of a contact database, an in-house contact database. So if you have any needs in regards to contact database creation, just call me or text me. I can help you with that. And I have also created a training program for real estate agents and mortgage loan officers, which I call the Real Estate and Mortgage Training from A to Z. My company, ReesSeminars.com, stands for Real Education from A to Z. All right, now that we're done with that, let's get started with the loan program. This is called the 3.5% FHA Own Option. Now, let me talk to you about what this program is. Let's go over the overview. This program is provided by a HUD-approved Indian reservation agency with the main purpose of expanding home ownership to all buyers who would otherwise not qualify for financing. Now, the key words in here that I want you to remember is HUD approved and people who would otherwise not qualify for financing. All right. This is a HUD approved program that helps consumers that would otherwise not qualify for financing. We're not looking for consumers that qualify for FHA or VA or conventional. This is for those consumers that do not qualify for those type of programs. So we're going to go over the details of that in a second. Now, the target clients for this program are first-time home buyers, self-employed people, 1099 and gig workers, people who have a new job in a different city, a completely new job in a different city that otherwise would not qualify for financing, and recent college graduates that don't have any job experience. And most importantly, those people that have ITIN or DACA. And I make a point out of this because there is a very large base of consumers who have employment, they have income, they file taxes, they have money in the bank, but yet they're not able to buy a property because they don't have a valid Social Security number. This program is going to be most beneficial for those people because there's so many of them out there. You can help many families get into homes that otherwise would not be able to do so. So let's continue here. And people that have credit issues that are preventing them from mortgage approval. In short, once again, I repeat it, buyers who otherwise would not qualify for financing, for traditional financing, okay? Now let's talk about the FHA Own Option Loan Program. How does it work? What does it do, okay? So this program is a branch of the FHA mortgages that is created to help facilitate home closings where applicants do not qualify for a traditional home mortgage. The FHA Own Option offers consumers a lease-to-own agreement coupled with an FHA assumable mortgage clause. Now, before you go crazy on me regarding the lease-to-own, this is not your traditional lease-to-own that people have used in the past and then they end up having troubles and etc. Right? This is a HUD-approved program, all right? So it is approved by the Department of HUD. And what it does, it has a lease-to-own component coupled with an FHA assumable clause. Now, if you don't know what an FHA assumable clause is, it's basically the ability that you have to have an FHA mortgage and have somebody else assume the loan. So the purpose of this is basically that sometime in the future, the buyer of the property it's going to be able to take the responsibility of paying the mortgage and placing themselves under the loan and title of this property. And we're going to go over and how that is done. So please bear with me. Continue watching the video because I'm going to explain to you exactly how it works, okay? Also, the buyer could, over time, build equity before refinancing or selling the home, and that equity that they are building on the property, it's applied towards the refinance or sale of the property. Now, I want you to think about this for a second. This is not an equity share program. The buyer keeps all the equity on this loan program, okay? All the equity of the home. This is not like you heard a few months ago, the program, the College FA equity share program, right? Where they give you 20%, and then later on when you sell the property, you give them their 20% plus another 20%. This is nothing like that. The buyer on the property can keep all of the equity of the property, basically, okay? All right, let's continue here. So let's go forward here. Let me put it graphically so you can see it a little bit better, okay? So traditionally, this is how it works, right? The buyer finds a suitable home and makes an offer and gets it accepted. This is typically what we do. We have a buyer, we show them properties, we make an offer, we get it accepted, right? So that's perfectly fine. That is part of the process, right? The next part of the process is that when you make the offer, you have to make the offer under the buyer's name or its assignee. So basically what it says, if your buyer's name is John Doe, you can say John Doe or its assignees, and you're basically put that in the contract, right? Once you open escrow, the buyer and seller assign the contract over to the HUD-approved Indian Reservation Agency, and then the buyer and the HUD-approved Indian Reservation Agency hold equitable title on the property until such time the buyer refinances the loan or sells the property and keeps all the equity. I want you to think about it, and I want you to explain it the following way so it's easier to understand, right? Equitable title. What does it mean having equitable title? Okay, think about it this way. What happens when you have a buyer that doesn't qualify for a mortgage because they don't have enough income? Or maybe they don't have enough money in the bank or something like that. What happens? We tell them, go get a cosigner. Go get a cosigner. We tell them, go get a cosigner, right? Go talk to your mother, father, sister, brother, etc. See if they want to cosign for you. But that's basically what you're doing here. You're basically bringing this HUD-approved agency that is going to get the loan on this property, right? And you're going to hold title with that property the same way that you would hold title with a cosigner. When you hold title with a cosigner, you basically with somebody else on the title. And that's basically what equitable title means, right? So I want you to explain it that way because it's a lot easier to explain it to people when they understand that this is basically how it works, right? Now let's go to the program itself. This is FHA, but better. And the reason I say is better is because on the bottom of it is an FHA program, but it doesn't have all the nuances of FHA. So let me explain them to you, right? So first and foremost, buyer needs to pay a minimum of 3.5% down payment, which is traditional and normal with FHA, but they can also increase the down payment to reduce their monthly payments. Now, let's talk about W-2 income. If you had a job for the last few months and you have a W-2 in that job, you can use that job regardless of how long you've been there. There is no season on W-2 income. As a matter of fact, you could have started a month ago in that job, and you could have been off of work for the last 2 years, and you still can qualify. As long as you have a job and as long as you have current income, you can use that income for qualification, which is unheard of on FHA financing. You don't see this on FHA financing, right? Secondary jobs. If you have a second job on FHA financing, if you have a second job and you have that job for less than 2 years, you cannot use that income. You can't use that income if it's less than 2 years, right? I have seen people fail because they had that job for 18 months, 19 months, 20 months, and they're not close to the 24 months, and they're not able to use that income. So in this loan program, you can use a secondary job regardless of how long you have been there on that second job. You can use overtime bonuses, commission income. You can use actual income for variable hours. If you're self-employed, listen to this carefully. If you're self-employed, you could have been self-employed for less than 2 years. So that means that, as a matter of fact, on the next slide, you're going to see this. They only require 3 months bank statements if you're self-employed. So that means that you only need to be self-employed for 3.5 months or 4 months in order to qualify for this program, which is fantastic. Tax returns don't have to represent the actual income because they don't even look at the tax returns. What they look at is the profit and loss statement and the bank statement. So we're going to go into that in a second. And this is a 40-year amortization that helps reduce the payments to the lowest amount. So you know how difficult it's been right now trying to get people into homes because their payment is this big and they cannot afford it. On a 40-year amortization, because it's amortized over a longer period of time, their payment drops. And because of that drop, now they're able to afford that payment. And I think that's fantastic news for most consumers. Regarding the cash to close, let's talk about the cash to close for a second. The cash to close can be a gift from a non-relative, which again is different than FHA, because on FHA, any gift that you're getting, it has to be from a relative. Not in this program. The gift can be from a non-relative, and also the gift can the money that you need to close. The money that you need to close doesn't have to be seasoned, and it doesn't have to be sourced, which means that you could have deposited the money yesterday. And as long as it shows available today, you can use that money, and they won't even ask you where the money came from. And this is fantastic, because I have seen a lot of people who tell me, hey, Ronnie, I have $100,000 in the house because I don't trust in banks. I have $100,000 in the bank. How can I use that money? And you cannot use that money unless it's sourced and is also seasoned, right? In this program, there's not such thing. You can use the money as long as it's in the bank available. You can use it whether it's seasoned or not, and the money can come from non-relatives as well. If you're an ITIN buyer, there is no credit score requirement. So there is no credit score. If you don't have a FICO score, it's okay. That's fine. If you have a bankruptcy, you can apply for this mortgage one day after a bankruptcy discharge. You can apply for this mortgage one day after a foreclosure is completed and recorded. There is less stringent underwriting criteria, and it also applies for single-family homes and approved manufactured homes. Look at all this. This is so much better than your traditional FHA, because it is FHA at its essence. It has all the benefits of FHA, but it doesn't have any of the nuances of FHA, which I think is fantastic. Let's go to minimum requirements. Minimum requirements: proof of funds for cash to close plus 1% mortgage reserve. So you need to have the cash to close, which means you need to have the down payment plus closing costs, and you have to have a 1% mortgage reserve. 1% of what? 1% of the purchase price. So let's say, for example, the purchase price is $500,000. You only need $5,000 reserve. So you need to have the cash to close, and you need to have 1% reserves. You're going to see an example of that in the next slide. There is no seasoning or sourcing requirement, as I already mentioned. You need to have a on-time housing payment history for the last 12 months. And the housing payment history needs to be documented by verification of rent, credit supplement, bank statements, anything that we can use to prove that you have been renting for 12 months. And the reason why that is because they want to make sure that you have a history of renting, that you are able to pay rent on time, for a period of time, right? They want to make sure that you have that history. Living rent-free is not allowed, unfortunately, because there has to be a history of rent payments for the last 12 months. And that has to be documented via verification of rents. It could be a credit supplement. It could be bank statements, canceled checks, etc. No evictions in the previous 2 years, and no unresolved housing collections. Now, somebody asked me the question. They say, hey, Ronnie, I have this consumer who owns a property. He's in process of foreclosure right now. They're going to foreclose the property in a month or 2 months. Can he buy another property using this program so he can let go of the property they're foreclosing? The answer is no. You cannot do that. You have to wait until the property is foreclosed and is recorded. And once it's foreclosed and recorded, you have 1 day after the foreclosure in order to approve again. Now, a first-time homebuyer class is required. Like in most down payment assistance programs, the borrower has to take a class, and they also have to talk to a counselor, okay, which is required, which is fine. It's typically normal for this type of programs. The high balance amount is $647,000. So if you keep it under $647,000, the down payment is only 3.5% down payment. But if you go over $647,000, it's 5% down payment. And if you go over $700,000, it's 10% down payment. A second home requires a minimum down payment of 5%. Now, here's a question that somebody asked me. If I have a buyer who already owns a property and they want to buy another home, can they buy it? And the answer is absolutely yes. And it only requires 5% down payment. Now, having said that, you have to remember that at its core, this is an FHA program, which means that the second home, the home that they're buying, has to be owner occupied. Okay, this is not a program that you can use to make yourself a millionaire flipping properties and renting properties. No, it doesn't work that way. This is an FHA program, and FHA is owner occupied. Now, the good news is that the property that you're leaving, the property that you're departing off, that property, you can use the rental income from that property to qualify for the next property that you're buying. So that's a fantastic news right there. So you can buy a second home with only 5% down payment, but it has to be owner occupied, and you could use the rental income from the property you're leaving for qualification purposes. The maximum debt to income ratio is 42%, 55%, which is very in line with FHA financing. FHA financing is 45, 55, so this is very, very close to FHA financing. Now, in regards to credit qualification, we need 2 active trade lines and 12 months of housing history. The 12 months of housing history I already talked to you about. In regards to the trade lines, you need 2 active trade lines. Now, the trade lines doesn't have to have a balance. If you don't have a balance on the trade lines, that's perfectly fine, but they have to be active and open. For W-2 employees, you need a 580 minimum FICO score. For self-employed and ITIN buyers, you need a 620 FICO score. ITIN buyers that have 0 score is okay. If you don't have a score, it's okay. I always say it's a lot easier to qualify somebody that doesn't have a score than somebody that has bad FICO scores. If you have a 500 FICO score, you probably won't qualify for anything. But if you don't have a FICO score, you may qualify for something. All right? So that's the credit qualification. In regards to the documents requirement, documents are the same as anything else. You're going to need to provide, if you are a W-2 employee, you need to provide the most recent W-2. You need to provide 2 months of pay stubs. You need to provide 2 months of bank statements, typical stuff. For self-employed people, you need to have a most recent tax return, a year-to-date profit and loss, and past year profit and loss. So a profit and loss from last year and a profit and loss from this year. Okay, a year-to-date profit and loss. You need to have 3 months of bank statements and verifying the cash flow. Remember what I told you. If you're a self-employed person, you could be self-employed for 4 months and you could be okay. You're going to be okay. You only need to provide 3 months of bank statements verifying that there is cash flow. And you need a copy of your business license. For new employments, you need a letter from the employer confirming the start date, the salary, and the first pay stub for verification. All right, that's all you need. And then let's see, 12 months on housing history. We already talked about that. You need verification of rent. You need bank statement, cancel check, something that proves that you've been renting for 12 months. And that's important, right? Now, if it's a non-landlord rental, that means that you're renting from your cousin Joe, all right? And Joe is not a property manager, all right? You're going to need an additional 3 months that they need to be documented. So you need basically 15 months of rental, all right? And if you're an ITIN recipient, we're going to need proof of the ITIN. So we're going to need the card, and we're going to need the IRS letter. Now, why we need the IRS letter? Because the IRS letter stipulates the name of the person, the address where they live, and the number that was assigned to them, right? A card, anybody can do, but an IRS letter is more difficult. So we need an IRS letter that specifies that you are the card holder for that ITIN, right? And that makes sense, right? DTI modifiers, I'm going to make it really simple, right? If you are a W-2 employee, your ratio, the maximum ratio is 42-55. Now, if you're self-employed, if you're buying a second home, if you have bankruptcy, foreclosure, you have no credit score, you make less than $50,000, etc., your DTI is going to be lower. I just want to mention that. I'm not going to go too deep into this, but I just wanted to mention that there are DTI restrictions. In regards to rates and costs, because everybody asks me, how much is it going to cost me and what is the interest rate? All right, let's get into that. So I want you now, before I go into that, I want to explain something to you. So on FHA financing, on traditional FHA financing, right, you have to pay down payment 3.5% and closing costs is around 2.5%. So you have to pay 6% for down payment and closing costs, 6%, right? That's what I tell everybody. You need to prepare yourself with 6% for down payment and closing costs. On this program, you're going to have the FHA cost, which is 6% for down payment and closing costs, plus you're going to pay 2.5% for brokerage fees. Why? Because they need to collect the money as an origination. They cannot collect it in the back. They have to collect it up front, and it is an origination at 2.5%. So you're going to need approximately between 8 to 9% of the purchase price of the property, plus another 1% for reserves. Now, reserves is not cost. It's not money that you're going to use. Reserves could be money that you have in a CD, in a money market account, checking, savings, cryptocurrency, a 401k, retirement account. It doesn't matter. You just need to have 1% of the purchase price of the property. On a $500,000 would be $5,000. You need to have that money somewhere, right? And then you're gonna need the closing costs, the down payment, the closing costs, and the broker fees. I tell everybody they're gonna need around 10% just to be on the safe side. 10% just to be on the safe side, because with 10%, that's probably enough what you need. So in this example here of $500,000, on a $500,000 purchase, the total amount of down payment, closing costs, and broker fees is $42,837. If you divide that by 500,000, that gives you around 8.5%. So they need 8.5% plus another $5,000 for reserves. That's another 1%. That makes it 9.5%. There you go. So you have, like I said, you're gonna need somewhere between 8 to 10% approximately to buy this property, right? And in regards to the interest rate, how is the interest rate? Well, if the FHA interest rate is today 7%, your interest rate is gonna be between 1.25 to 1.5 higher than the current interest rate. Now, it does depend on the FICO score. So if your FICO score is over 660, it's going to be, like, say, for example, 8.375. If your FICO score is between 620 to 660, it's going to be 8.625. If your FICO score is between 580 to 620, it's going to be 8.875, which is very much the same as a down payment assistance program. If you look for college FA rates, the college FA rates today are around the same level, So this is not the interest rate of a, hard money financing or anything like that, or a non-QM loan. This is more like the interest rate of a down payment assistance program, okay? And you have to remember also that this is a 40-year mortgage. That means that even if the interest rate is higher, the payments are actually going to be lower, could be potentially lower than FHA, because it's amortized over 40 years rather than 30 years. So even with a higher interest rate, the payment still could be less than a 30-year mortgage. And so let's talk about the process for a little bit. So the process goes like this. First of all, your buyer needs to be pre-approved before making offers. Yes, don't call me tomorrow and say, hey, Ronnie, I just got an offer accepted yesterday. Can you get it approved? Because the approval process takes a few days. The file needs to go over to their underwriter, and their underwriter has to approve it before it comes back to us and we can get it approved. So you need to have your buyers pre-approved for this program before you show them properties and before you start making offers, okay? Number two part of the process, step number 2, FHA issues the loan to the HUD-approved Indian Reservation Agency. I already told you that. Step number 3, buyer in the future, whenever they're available, they can refinance or pay off the loan, and then the title is transferred to the original buyer, which is the buyer in this case. Now, step number 4, or the buyer sells the property, pays off the loan, and keeps all the equity. Again, this is not an equity share program. They can keep all the equity in the property. Escrow steps and purchase assignments. So how does that work? Well, the buyer completes the purchase agreement and deposits the earned deposit in escrow, the EMD. The seller and buyer then assign the contract over to the government entity. Appraisal is ordered and completed with investor's preferred vendor. A home inspection is always required, and all FHA repairs need to be corrected. Let's talk about that for a second. FHA requirements when it comes to the property, right? So FHA has rules that I want you to think about those rules in regards to safety and security. Safety and security. FHA wants to make sure that the property that the buyer is buying and the property they're going to move into is safe and secure, which means that the doors and windows need to be in good working conditions. They have to have good plumbing and electrical. They have to have a functional kitchen with a stove. They need to have a water heater that is double strapped. They need to have carbon monoxide and smoke detectors. They need to have roof that is in good condition. So watch this. You have 6 things that you're looking for: doors and windows, electrical and plumbing, functional kitchen with a stove, water heaters double strapped, carbon monoxide and smoke detectors, and a roof that is not leaking. Those are the things. Now, FHA doesn't care if the carpet is run down. They don't care if the walls need paint. They don't care if the cabinets look ugly. They don't care about cosmetic. All they care about is to make sure that the property is safe and secure. So this is ultimately an FHA program. So all the repairs need to be completed by the seller. You don't need to request the repairs on the purchase agreement because, quite honestly, you don't know what the repairs are until you do the inspection. You can request them using the request for repair form, which is the RR form. Then after that's completed, the loan is funded. The buyers can move into the home. They just purchased a piece of California. They own their own home. They lock their payments for 40 years and build equity over time. And that is the process of the escrow and the purchase assignment. Now, how do they gain direct ownership of the property? Now, in the future, they want to gain direct ownership of the property, right? How do they do that? Well, the buyer can gain ownership via refinancing or via sale of the property or equity sale of the property, right? Now, there are some restrictions in regards to the sale of the property. The restrictions go like this. The buyer may not sell the property for the first 2 years. So there is a sale restriction. You cannot sell the property for the first 2 years. But I mean, who would? I mean, if you're looking at buying properties right now, you're looking at long term anyways. You're looking at 5 years, 7 years, 10 years down the road. If you're looking to buy a property for less than 2 years, you're not a homeowner, you're a flipper. And this is not the market for you, right? So there is a restriction for 2 years, and there's another restriction, which is a prepayment penalty of 2% of the purchase price if they sell the property within the first 3 years. So if they sell the property within the first 3 years, they need to pay 2% of the purchase price. So if the purchase price, the current purchase price, that is, if the current purchase price was $500,000, 2% of $500,000 is $10,000. So there is a prepayment penalty of $10,000 if they sell the property within 3 years. Now, after 3 years, there's no sale clause, there is no prepayment clause. After 3 years, you can sell the property or you can do whatever you want with the property. Now, to gain direct title of the property, once again, the loan needs to be paid off. How do you pay off the loan? Well, you can refinance the loan, you can sell the property. I mean, whichever way you want to do it, you can do it as long as you pay them what you owe them. As long as you pay the loan that you currently have standing, you can get that done. Buyer sales, pays off the loan, retains all equity. We talked about that. The buyer can deduct all interest payments for tax purposes. So any payments done on the property can be deducted for tax purposes. That includes the purchase payments that they did, all the cost of buying the property, their interest that they're paying on the property. All of that is tax deductible. They can use that. So it's basically owning the house outright. Now, there are some restrictions. I went through the whole thing and I found 2 restrictions. What I want to talk to you about, it's called equitable title and restriction on sale and transfer. I want to explain them to you the easiest way that I can explain it to you, so you can explain it to your client the easiest way that you can explain it to your clients, or you can tell your clients to call me and I'll explain it to them, right? So basically, this is the way that it works. Like I said at the beginning, the government agency is buying the property, and they're giving the buyer equitable title on the property. That means that the buyer has equitable title. They have the right to live on the property. They have the right to paint it a different color if they want to. They have the right to make improvements if they want to, etc., right? All of that is understood, right? Now, there is restrictions in regards to what you can do with the property, because remember, this is an FHA mortgage. So the property cannot be subleased. The property cannot be rented outright. The property cannot be used as a short-term rental like Airbnb or Vrbo or anything like that, because at the end of the day, this is an FHA property and you have to own or occupy that property. Again, this is not a program that you use to make yourself millionaire doing flipping properties, basically, right? Now, the second restriction is in regards to permission to sell. Now, let me explain it to you, because when you look at it on paper, it looks kind of scary, but it's not. Basically, what it says that before you can refinance or sell the property, you need to ask permission from the agency to refinance and sell the property. Now, some people say, oh, I don't want that. I don't want to ask permission. Well, think about it. If you were to bring a co-signer to buy the property with you, if you ask your cousin George to come and co-sign for you to buy this property, if you wanted to refinance or sell the property, didn't you have to ask George to come and sign off? Wouldn't you ask permission from George if it's okay with him that you sell or refinance the property? You would. So now, because we had concerns regarding this, we actually reached out to the administrator of the program, and she told us, she says, you know, Ronnie, we don't have any restrictions on sale as long as we get paid what it's owed, right? As long as we pay what it's owed. If your property has equity and they want to sell it after the 2-year or 3-year mark, like I said before, we don't have any restrictions. They want to refinance it, we have no restrictions. They can do whatever they want with the property, right? But they do have to ask permission to do that because we are on the title of the property, and that makes sense. If you had cosigners on the title of your property, you would need permission from the cosigners of the property to make decisions about the property. That just makes sense, right? But as long as they have equity on the property, they can sell, they can refinance the property. And all they need to do is send them an email and say, hey, I need your permission to sell or refinance the property. They will look at the numbers. They'll make sure everything is okay. They make sure that they get paid whatever they're owed. And once that happens, everything is okay. So I wanted to talk to you about it and put it under the right context, because this is where most of the people have problems with. You know, they say, well, you know, I don't want to. Well, if you had a cosigner, it would be the same situation. You would have to ask your cosigner for permission to refinance or sell the property. I just want to make sure that we are very clear when we talk to consumers that this is the way the program works, so they understand exactly how it works. I have this mantra, or this thing that I do, that I always tell my consumers. I want to tell you everything up front because I don't want you to come later on and tell me that I didn't tell you something, right? I want to make sure that you know everything up front, so there is no questions at the end on how this works. So I wanted to make sure that we clarify that point. But that's basically that. Let's see what else. And that's about it. So this is the end of the seminar. You have all the information that you need. And if you need to communicate with me, please call me, text me, or email me. My name is Ronnie Velasquez. My phone number is 562-762-9634. My email address is rvelasquez@banquanmortgage.com. Thank you so much for watching. I'll talk to you later. Bye.